Hello, and thank you for listening to Living Wealthy Radio, heard around the web on livingwealthyradio.com, iTunes, and Blog Talk Radio. I am Teresa-Kuhn, helping you live wealthier. Resources are available for you at livingwealthyradio.com.
Hello, and welcome to the Living Wealthy Financial and Living Wealthy Radio webinar and podcast. Today's topic is the myths of home ownership. My name is Kristen Kolka. I'm a bank owner self-authorized advisor with Living Wealthy. And joining me today is Teresa-Kuhn.
Hi, welcome everybody. Thank you for joining us. Living Wealthy Financial and Living Wealthy Radio presents the myths of home ownership. Excited that you're here joining us. And our expectations for you are that you're going to walk away going, I didn't know that, or that's interesting, or oh my gosh, why didn't I learn this before? Kristen, thank you for helping set this up, and I'm excited for us to share this together.
Yeah, absolutely. I am as well. Let's get started in talking about some of the common myths of home ownership. And Teresa, the first myth here is that owning a home is always better than renting.
All right, so I'm going to play devil's advocate. We have been told from the beginning of time that you want to own a home. It's so important to own a home. Everybody wants to own a home. Kristen, why is this a myth? Why isn't it a good thing to own a home? Why would you want to throw away rent money when you could be building your own equity?
Well, when you think about what statistics say about how many jobs young people have today, I believe they go through about 11 jobs in their lifetime. And in many of those cases, they have to move to start a new job or move up in their career. And so when you're purchasing a home, you have to live in the home for a certain amount of time in order for that purchase to actually benefit you. So you really want to ask yourself before you own the home, how long are you going to be planning to stay in the area? And how long do you want to live in the home?
Well said. That is a really, really good point. And what we've found over the years, and we've been working with money for a very long time now and have seen probably everything that one can see when it comes to money. From a budget perspective, owning a home blows a budget. It just does, right? So when you rent, you've got an issue with the roof, or you've got an issue with your heating or air conditioning or your toilet. You call up a landlord and they fix it. Hopefully, right? They fix it. But if you own the home, you've got to pay for it. Now, if you're not really on a budget, or you're a higher income person and you're stable and you don't expect to move, then it might be a little bit different, right? But a home is not an asset per se. It really is a liability. And the other thing that happens, Kristen, and I know you know this working with our clients, what happens when, and it's going to sound sexist and misogynistic, I don't mean it that way at all, but what happens when a couple moves into a home, and what does the couple want to do, especially the wife if they've got kids?
They want to nest.
They do. They want to nest. And what's involved in nesting?
Fixing up that home, buying furniture, fixing up the bedrooms, decorating.
Cha-ching, cha-ching. You want to talk about a budget buster? There you go, right? You know, and then you start fixing up a bathroom, and then you start fixing up the other bathroom, and then you do the kitchen, but then the living room looks old, and then you want to paint, you want to decorate, and it's just tens of thousands of dollars, and in many instances, you don't get that back. So unless you've got extra money that you can set aside, and unless you're stable and you plan on staying somewhere, really owning a home isn't all it's cracked up to be. And I've got one more comment or question for you, Kristen. How many couples have you worked with that when you go through their assets and their liabilities, one of their liabilities after they bought a home is for furniture in terms of credit? They go out and they rack up thousands of dollars in furnishings. How often have you seen that?
Oh, so many times. And it's crazy because all of these furniture stores now, they offer these appealing incentives. You know, if you purchase the furniture, you don't have to pay interest for a year. And a lot of people will buy the furniture thinking that they're going to pay off that furniture loan within that year-long period that they're not paying interest. But things happen. And if you don't pay off that furniture loan by the time the promotional period is over, the interest rates can be through the roof.
So we're going to be dropping a ton of nuggets throughout the presentation that don't necessarily sound like it has anything to do with owning a home and the myth around home ownership. But here's a nugget. These furniture companies, car companies, really any retail that sells a commodity, they're not necessarily making a whole lot of money off of the commodity they're selling. They're making the money in the financing. And that's a whole nother topic for another conversation. But I want you to think about, bank on yourself, becoming your own banker, infinite banking concept. Why is that word or that concept in there? Because there's a lot of money in it, right? And so the furniture stores are selling the commodity. They're financing 0% interest. Do you think it's because they're so nice and they want to accommodate? No, it moves furniture, and they know so many people don't pay back within that 0% period of time, typically 12 months, and they end up paying interest from day one, right? And our clients sheepishly say, oh, we've got the furniture, but don't worry, we're going to pay it off within a year. It's like they're apologizing for it because deep down they know it doesn't serve them. But it goes back to, you buy a home, you want a nest. It's just natural. It's genetic. It's how women are wired, right? And we just spend a ton of money fixing up our homes. So let's go to the next one.
Yeah, absolutely. And that ties into the second myth of owning a home. And that is that buying home is a no-risk investment.
Well, just ask those who bought homes before 2008. This used to be true. I mean, this used to be, one of those sacred cows, right? You got to buy a home. It's the best investment. It'll never go down. What happened in 2008, Kristen?
Right. The real estate market crashed.
And what happened to so many people who overbought in terms of what they could afford?
Sadly, a lot of people lost their homes.
Yeah, they did. Real estate does not always increase over time. And for some people right now, they're just getting their equity back into their properties. And another thing to consider, just because a mortgage company is willing to finance a mortgage for a certain amount doesn't mean that's the amount you should finance. Our clients, our wealthier clients, this will be a nugget that I want you to think about. The way you accumulate wealth is to have a gap between your income and your expenses. The mortgage companies, the finance companies, the credit card companies, the banks want that gap to be as small as possible because that's how they make their money, right? So if they say you can afford a lot more house than really makes sense to, if you don't have that gap between your income and the expenses, you're not going to be able to save. And the saving is what's going to help you accumulate your wealth.
Exactly. And aside from decreasing property values, there's also our unforeseen maintenance costs and repair expenses. And like you said, if you don't have that gap where you're saving money, you're going to have to, again, go to the credit cards to finance those expenses.
You got it. So there's, again, HVAC, what if you needed a new heating and air conditioner? What if you needed a new roof? What if you've got a leak somewhere, right? Somebody was just telling me about a leak that they had in their home. They couldn't figure it out where it was coming from. They spent over $30,000 trying to identify where that leak was coming from in terms of foundation work, et cetera. It turned out it was a leak in their HVAC system that nobody could find. And $30,000 can really wreck someone's budget or savings. So, yep, unless you've got a lot of money in reserve or a specific amount in reserves, it really is, probably not ideal. And I've got some clients, and Kristen, I know you know who they are, that they had a lot of debt when they got married. And I've seen this several times, and they rented and lived super frugally, got rid of all of their debt, and then started saving for a home because they knew that they wanted to raise their kids around the grandparents. That was ideal. That's a perfect scenario. If you are thinking of buying a home, make sure you don't have any other debt and make sure you've got reserves.
Absolutely. Our third myth is that your home should be your biggest investment.
Explain that myth a little bit more so people really understand what the myth is.
So basically what they're saying with myth number 3 is that in terms of what you're putting your money into, your home should be the thing that you're putting most of your money into.
How crazy is that? The analogy we use is dig a hole in your backyard and put all your money in there and forget that it's there. So it's literally like digging up a hole and pouring your money in there. It's ridiculous. Now, what do people say counter to that, Kristen?
Well, what you say counter to that is your money is locked up in your house. How are you going to access that? And if it is your biggest investment, and if you plan on using it as a retirement asset, you're still going to need a place to live.
That's right. And the counter to thinking that, well, no, I've got cash, I've got equity in my home and I can tap into it at any time, that's not necessarily true. Back
Right.
in 2007, 2008, 2009, 2010, we had clients whose lines of credit, they had an equity line of credit on their home and they thought that they could access it at any time. And that was just peace of mind for them. Boy, were they shocked when they got a letter from the bank saying their line of credit was closed and that their outstanding balances they had to make payments on. They were shocked. They could not believe that could happen. Rule of thumb, banks can do anything that they want. Anything. Who do you know, Kristen, has read the fine print when they get a mortgage?
Not many people. And that scenario that you're mentioning happened to people over and over and over again in 2008.
You got it. Yeah, it's crazy. And so don't let this happen to you, right? You should have your own line of credit. You should have your own reserves. And to think that the money that you've got in your property can be your biggest investment, again, it goes back to, I think, just really bad information.
Absolutely. And so that really ties into the last myth that we're going to talk about today. And it's myth number 4. Is your home really an asset, or is it actually a liability?
Well, I think people will argue that, of course, my home is an asset. It's on my balance sheet, right? If I do a personal balance sheet, my equity in my home sits on the left-hand corner of my balance sheet. It is an asset.
Right. And I think the old school conventional way of thinking is that you get your mortgage and you try to pay it off in 15 years or less.
I did that. I did that when we first got married. Our first several mortgages that we had them on a 15-year mortgage. What a mistake. We did everything by my training, my financial planning training, right? We did everything by the book and realized from a practical perspective what a mistake that was. And we call it the old rules versus the new rules. And another word that I love is the old paradigm versus the new paradigm, right? And there's some things that the old paradigm is actually correct. It's actually, good. But in this case, it's really an old paradigm. And so that old paradigm is get the lowest rate mortgage, which actually that's good to get the lowest rate mortgage. You don't want a high rate for your mortgage. Start a biweekly mortgage payoff plan, or send in as much money as possible to reduce the principal and paying off the mortgage as quickly as possible. Well, that was an old rule. The banking industry, of course, wants you to reduce your principal as much as possible because they reduce their risk as much as possible. But that increases your risk, because if something were to happen to you, if you lose your job or you need to move, you cannot get access to your equity.
Absolutely. And so some reasons that you should always carry a mortgage. So the first one here is that mortgages actually don't lower home values.
So explain that a little bit. What do you mean by that, Kristen?
So if you have a big, huge mortgage on your home, it's not affecting your property value. Your property value can still go up, and you can still build equity in your home.
Yep. That makes sense, right? It makes common sense, but people don't necessarily think that way. Yep.
Absolutely. And then the next one here, your mortgage is the cheapest money you will ever buy. And I think this is a really important one, because especially in today's interest rate environment where people are getting mortgages at 3% and 4%, it is very cheap money. But when we start to look at the numbers, I think you'll see that it's actually not that cheap.
Yep, you got it.
The third one here is that your mortgage is the best way to lower your taxes. And Teresa, what do you think about that one?
Well, with the new tax laws, that's not necessarily true. It depends your tax bracket, and depends how much interest you're paying on your mortgage, right, every year. So I would say not necessarily true anymore.
Right, absolutely. So we say get the money out of your house while you still can, and your mortgage becomes cheaper over time.
So we need to share some numbers on that one, because people are thinking, what do you mean my mortgage becomes cheaper over time?
Absolutely. Absolutely. And carrying a mortgage, you actually have protection in the event that you lose or quit your job. If you think about the fact that if you take on a 15-year mortgage, you're going to have a bigger payment. If you have a 30-year mortgage, you'll have a smaller payment. If you still want to pay your mortgage off quicker, you have the ability to do that, to put some extra cash flow towards that mortgage balance, but you don't have to. You're not locked into that payment. So if you carry a 30-year mortgage with a lower payment, you do have some protection and some budget wiggle room if you do lose or quit your job.
Totally agree.
All right. So Teresa, let's take a look at the numbers. The first screen that we'll have here is a traditional loan amortization schedule. And did you want me to go through the numbers?
Absolutely.
Okay. So this is pretty typical of what we see. This is a person that took their loan for their mortgage in January of 2010. It was a $400,000 loan. They got approved at a 3.75% rate. They're going to pay that loan off over 30 years, and their monthly payments are just over $1,800. Once they finish paying off this loan in full, the total interest that they'll pay to the mortgage company is $266,886.45.
Well, the 3.75% annual interest rate is a really, really good interest rate. And it really is the cheapest money that somebody will be able to borrow, right, in terms of a long-term loan. So that's certainly one thing to think about. Locking in, getting a loan for $400,000 at 3.75%, historically low interest rates. At some point, interest rates have to go up, and we'll look back at this time and say, "Oh my gosh, why didn't I buy more real estate at 3.75%?" Right?
Yes, absolutely. All right. So should we look at what this amortization schedule looks like for someone that does have some extra money to put towards their mortgage balance?
Yep.
All right.
So we get this all the time. I've got extra money that I'm paying towards my mortgage.
Yes. And in this case, this person had an extra $300,000, and they were trying to decide where to put it. Should they put it towards their mortgage and get their house paid off, or should they put it into a savings or investment vehicle? And running the numbers, if they were to put it towards their mortgage here, they could get their home paid off in 128 payments versus 360, so about a third of the time. They would have their mortgage paid off completely by 2020. And they drastically reduce the amount of interest that they're paying towards the mortgage company. So $135,842.06 versus that $266,000 number we looked at just a minute ago.
Considerable. I mean, that's a considerable savings, right? $135,000, almost $136,000. But once it goes into the home, if you need to tap into it, you've got to apply for financing and you've got to qualify. So if you're not working, if you're sick, if you're disabled, if your income has dropped and you want to access some of the money, can't call up the bank and say, I've got great credit and I've been a really good customer and I promise I'll pay you back. Can you give me some of my money? They're going to say, nope, no way. It's an either or. Every dollar that goes towards paying down that mortgage is an either or dollar. You can either put it into your home or you can put it someplace else. We think we've got it better someplace else.
Absolutely. And so what we suggested to this client is that instead of putting $300,000 directly into their home, what if they structured that money into a bank on yourself, infinite banking concept type of policy? They can still pay off their mortgage early by utilizing that policy, and they can have the benefit of both assets. And so this is what that looks like. So the alternative scenario that we put together for them, they're able to borrow out not quite $300,000 from their policy, but $253,000 from their policy. They still get the loan paid off a considerable amount of time sooner, and they're still saving a considerable amount in interest. So $138,000 of total interest that they're paying in this scenario.
Yes. So in this scenario, they had an extra $300,000 to put towards their mortgage. And I know what you're thinking, you in the audience, for saying, I don't have an extra $300,000. No, you probably don't. Some of our clients do. They can, just write checks and pay off their mortgage. But think about if you've got an extra $1,000, $1,500, $500, the concept is still the same. The numbers may not apply to you, but the concept is still the same. And that's what we want you to walk away with, is the concept, conceptually, how this can apply to you.
Absolutely. And so this is some more information about the alternative scenario that we talked about.
So basically what they're creating is they're taking their $300,000, putting it into a policy first, a bank on yourself, structured policy, or an infinite banking structured policy. The way we design our bank on yourself and infinite banking concept designs are the same, right? This creates from day one an $823,000 life insurance policy in terms of face value death benefit. That is day one. So with those dollars, creates over an $800,000 asset, and they can borrow up to $255,000. And if they want to pay the mortgage, they can still borrow against the policy and pay down the mortgage, and then they become the financer, the lender for their property. But over the lifetime, right, once their mortgage is paid off, if they just want to continue down their track and then start making payments towards their policy, then what they're doing is creating an asset at age 60 of $1.6 million with over $661,000 of cash value. And all along the line, right, all those years, which is what? It was over 23 years, 24 years, Kristen?
Right. Yeah, he was 35.
He was 35. They've had access to 25 years. They've had access to those dollars. They don't have to beg the bank to give them money. They don't have to jump through hoops. All they do is make a phone call and say, I'd like access to my money. I'd like to take out a loan. And they created that death benefit. The numbers are so exciting. Kristen, let's change the screen and actually look at the illustration.
Yeah, absolutely. So this is the actual illustration for the client illustrating this concept.
Okay. Explain to the audience what we've got here.
Yeah, so it looks a little complicated.
Yep.
But as you can see, the $300,000 is going into the policy as a contract premium year one. This is a single premium contract, and so there's no more premiums that get paid into this policy after the first year. You take a loan of $253,000, and you can take that loan in the first year. We're a little limited in our software, so it does show it coming out the second year. But what you're seeing here is that once the loan is taken from the policy, there's about 3 years there that no payments are being made back towards that loan. And that's because this person is still paying down their mortgage, right? They don't get it paid off until 2022. But once they get that mortgage paid off completely, they can now redirect those mortgage payments back to their policy, get that policy loan paid off. And if they do that, they'll have the loan paid off by the time they're 60. And as we just talked about, the cash value at that point in time is $661,000, and he has a $1.6 million death benefit, plus the full equity and full ownership of his home.
I know. It's amazing. I love it. But the best is yet to come.
Absolutely. Because with this type of policy, they don't just have the cash value and they don't just have the death benefit, but they also have living benefits in the form of an accelerated death benefit rider. And this rider gives them access to their death benefit if they're suffering from a chronic illness, a medical condition, or a terminal illness.
Now, chronic illness, specified medical condition, terminal illness, I'll give the disclaimer. The definitions of this really is by state. It's very state specific. But overall, big picture, Kristen, what does chronic illness mean?
So chronic illness means that you're not able to do 2 of the 6 activities of daily living. And this includes things like dressing, showering, toileting, things like that. If you're not able to do those things, you are going to require some care, and that can happen at a nursing home or at home with a at-home healthcare nurse.
And the specific medical condition?
A specific medical condition, it really covers a wide variety of different things. But think about medical conditions that might require a long hospitalization. And so this would include things like, a heart disease or cancer.
And then terminal illness is basically that, right? Your doctor has said you have less than 12 months to live. And so I want you to think about, this design. Number one, it's proprietary to our organization. So the Bank on Yourself organization is really the only one that can access this type of design. It's very, very unique in the industry, and it's just remarkable how well it works.
Yep.
So for chronic illness, imagine being 67 years old and having a major health issue and having access to over $1,080,000 in a check to go anywhere in the world to get treatment if you want, or do whatever you want. It's not a reimbursed plan where you've got to show receipts. It's what you've got access to and still have death benefit for your family and loved ones.
Absolutely. And I think that's really the beauty of Bank on Yourself and the infinite banking concept is the control that it gives you over your outcomes.
So well said. The quality of someone's life is in direct proportion to the quality of options that they have. And this is so true when it comes to finances, right? You see people who really don't have that many financial options as being very, very limited. by having the dollar, right? Every dollar that could go to pay your mortgage down, you use that dollar and you put it into a policy first. It's not an either or dollar, right, being spent. It's, I can spend my dollar here, I can borrow it out and pay down my mortgage if I want to. If I die, the money pays my family. If I have a chronic illness or I have a medical issue, or if I'm terminally ill, I have access to dollars. That money continues to work for you, harder for you than any other strategy that we know of. And you don't have to pay your house down if you don't want to. Remember, we talked about in this example, the interest rate was 3 3/4%, historically low interest rate, right? Why would you necessarily want to pay that down? Go take the money if you want and invest in something else. Invest in another real estate property that really is an investment as opposed to your home that really is a liability.
Absolutely. And so here are some of the other benefits of Bank on Yourself and the infinite banking concept. And as we've been discussing, it gives you options, the liquidity, use, and control of your cash, and the ability to borrow against the cash value and continue to earn dividends as if you never touched it. So with the example that we looked at, it did include dividends, and we should disclose that those dividends are not guaranteed. They're based on the profitability of the insurance company. But if you do take a loan from your policy, you get the same dividend that you would have if you had never touched your policy in the first place. So that person would have had $661,000 by the time he was 60, whether he had taken the loan to pay off his mortgage or not. He also has the flexibility to pay back that loan however he'd like. We showed that he redirected his mortgage payments. He could pay more or less towards his Bank on Yourself or infinite banking structured loan if he wanted to. And then, of course, he has the death benefit protection. He has protection against creditors, lawsuits, and bankruptcy, benefits in the case of long-term care, critical care, or terminal illness. He could convert his cash value to an income stream in retirement. He has guaranteed growth. The gains are locked in each year. He's not going to lose money if the market crashes. And he has the tax deferral and the tax favored income, just depending on the policy design.
Beautifully said. Compare that to your money strategy today, right? Think about what strategy you've got that gives you this much flexibility and gives you, that your dollars are working harder for you. I don't know of any other.
Absolutely. Well, Teresa, we're at the end of our presentation. Any last words for our listeners and our viewers at home?
Any more information that you'd like, of course, contact us. Our website is livingwealthyfinancial.com. And you can call us. I know these numbers are somewhat, you're looking at it, you're hearing us, and you're saying, those aren't my numbers. My numbers are very different. I don't have $300,000 to put down into a policy or pay down my house. Or maybe you've got $1 million and you're wondering what to do with it. Should you pay off your home? Should you go pay cash for an investment or, invest in your buddy's company? Just think, if you put it into your policy first, those dollars are creating two assets for you at the same time, as opposed to once you invest, that's it. It's very difficult to take that money back, right? So beware, give us a call. It doesn't cost anything to talk to us. We'll walk you through your scenario. And if it's not right for you, we're the first ones to tell you. We'll tell you, this isn't going to work out for you, or this isn't going to work out the way you're thinking, or, this isn't the right timing for you. I mean, it's not just figuring out, making it fit your scenario, making it fit into this strategy. We're the first ones to tell you if it's not for you.
Absolutely right. Absolutely right. Well, thank you so much for joining us today, and thank you, Teresa.
Of course. Thank you, Kristen.
All right. Bye-bye.
You've been listening to Living Wealthy Radio, heard around the web on livingwealthyradio.com, iTunes, and Blog Talk Radio. Download or subscribe to our podcast to hear a new show every week. I am Teresa Kuhn, and I hope you'll join me again next week as I show you ways to live wealthier. Resources are available for you on our website at livingwealthyradio.com.